Hello, everybody, and welcome to the Investing with IBD podcast sponsored by Vantage Point. It's Justin Nielsen here, your host, and joining me, as always, it is Arusha Pires from O'Neill Global Advisors. He's a portfolio manager over there. How are you doing, Arusha?
I'm doing well, Justin.
And on the show, as our special guest, we also have Kathy Donnelly coming back to the show. She is a co-author of the Lifecyle Trade, and she's been a meetup leader for many, many years, and was one of those attendees at so many of our events. So I've known Kathy for, gosh, I don't know how long. But Kathy, it's great to have you back on the show.
Thanks, Justin. It's great to be here as always.
So we're going to get into the markets, of course, kind of see where things stand right now. And then Kathy's going to talk a little bit about how she goes about finding those first stage bases, getting stocks early in their life cycle. And then, of course, we'll talk about some of the stocks that are on her radar. So let's hop right into it. Rusha, you want to pull up the NASDAQ composite for us? And Kathy, let's get your take here. We had a little bit of a pullback. We got the NASDAQ composite going down below our 21-day moving average line. Is it time to go get the canned goods and get into the bunker?
Yeah, I've probably been in the bunker for a while now.
Okay. you never came out?
I didn't come out. Obviously we have had a little bit of run up from the bottom, and I have played around with some small 1% positions here and there, but I've been enjoying kind of the time off, still looking at charts every week, of course. And, but from my perspective, the pickings, it's been slim pickings. Mm-hmm. And even now, we're starting to correct from this run that we've had. You have the 10-day moving average declining and the 21 EMA moving average declining, and we're below the 21 EMA. So I think we're due into maybe some type of correction of some sort. So hopefully, though, this will finish off some bases. I do see some potential, and this will help it along. And then maybe we'll see some potential in another month or so.
And what are some of those kind of things that you're going to look for maybe in a month or so that will maybe get you a little bit more confident and increase your exposure from 1% positions maybe to 5% positions?
Well, the 1% positions that I've kind of delved into, I was hoping would then build another type of consolidation where then, with the market being stronger, the ones that already have, and those can get like a full position size on them. But it hasn't happened yet. So I'm really focusing on that institutional due diligence phase that I've talked about many times on the show, where the IPO goes up or goes down and then goes sideways for a long period of time, and really searching for those first stage bases that we're going to talk more about today. But it can apply to stocks that have been around for a long time, and we're going to talk about that too, because it's that 40-week line where it's a real sweet spot for bases to form after big corrections. And then, of course, IPOs coming from their institutional due diligence phase before they have their next run up, hopefully.
Mm-hmm. So we had the follow-through day at the end of June, so June 24th. What was it about that follow-through day that made you a little suspicious and made you want to wait and basically stay in your bunker?
Well, when I would run my screens, all I saw were huge downtrends. Mm-hmm. Everything I looked at was just down. And I'm like, well, I'm not a bottom buyer.
Right.
I don't buy off the bottom. So for me, it was a waiting game for some prior run-ups to create that first base, or some sideways action, and then some tighter action from that, because it was very volatile during that time. And yeah, we had a follow-through day, and I know we're supposed to buy something, and maybe I did, and actually I did, but they were things that I don't normally buy and ended up losing. So I had to go back to my basics and say, what do I like to buy, and just buy that. So if there's nothing to buy, there's nothing to buy.
Mm-hmm. Yeah, and so talk a little bit more about that discipline, because I think that's a really good lesson. It doesn't seem like you're suffering from the fear of missing out or anything here. You're kind of waiting for your game, the fat pitch to come through and really go increase the position sizes when the odds are more in your favor.
Yeah, I definitely want the fast pitch, or the fat pitch. I don't know if it's fast or fat. Anyway, but yeah, when I buy a stock, and Arusha, you and I talked about this, I think on the very first podcast we did together, I'm always looking for those 100%, 200, 300% or more.
Yeah.
Yeah, I'm okay if I get 20%. And actually, one of the ones we'll talk about today was a 20% opportunity. But I'm looking for that big gain. And so that big gain for me is that institution due diligence phase, the institutional advance phase, because that's where you have the most potential. And that's what we've seen over the years. And Bill said it, recent IPOs. And so, yeah, I have the patience because I don't want to be watching the screen all day. If I can buy that first stage base, hold on, add more at the second stage, I'm really just relaxing through the run instead of always looking at my phone. Oh, I got to buy, I got to sell. It's just not worth that to me. I'm lazy in that way, but it's not really lazy. It's just, that's my style.
Yeah, well, you like having a life, and you're doing your training for your triathlons, and I mean that takes quite a bit of time when you get a couple Ironmans under your belt. That's some serious training there. And this has been, I think at least, a market of singles and doubles if you're lucky. It really hasn't been a market of those home runs. So I totally get what you're saying. If you're okay waiting and being patient, those fat pitches will come and you'll have those opportunities. And okay, so maybe you don't get 130%, but if you get 100%, I mean, isn't that enough?
Yeah, I mean, you only need, we've said this before, and Bill said it, was just a handful of stocks that you really need to change your life in one direction or the other. So why not wait for those? Patience is a virtue. And yeah, I get the itch to trade just like everybody else, but I've enjoyed these last few months with just a few 1% positions here and there, just kind of testing the waters. I'm still connected with the market. I'll never, you can't turn your eye away from it. You have to be in sync because stocks wait for no one, right? That base can, form at the end of on Friday. And I love that when that happens. Like I see a base maybe forming and then Market Smith picks it up on that Friday and I'm like, yes, that's what I'm looking for. And then, and then I'm ready to go when the week comes. So
talk a little bit about your routine. So is it more a weekly routine where you're doing most of your work on the weekends, or are you doing a bunch of it during the weekdays too?
It's definitely on the weekend. I try to do it on Fridays after the market closed, but I found there's just too much time between Friday and Sunday that I just forget what I was looking at.
Yeah.
So basically Sunday evening, I run my screens. My number one screen is IPOs, recent IPOs the last 2-3 years, $100 million a day or more. And then I also run between 20 and 100 million. And I do run the WAN screen, the William O'Neill screen, with liquidity of 100 million or more, and then also the MS250. But I usually find that those are more mature stocks. And so I'm not as interested in them, but it's also good just to, stay in contact with what everything's doing. But my key focus is those IPOs. And usually, unless they're right near the end of a base building, it's not going to my ready list. So if I don't see it on Sunday, it's no problem waiting until the following Sunday to see what changed.
Mm-hmm. Now, maybe you could also share with us, because last time we had you on, you also were exhibiting a lot of patience on the sell side. You're waiting until sometimes the 40 week is breached. It's not like you're looking for, the 10-day. Again, you're really kind of trying to get the big move out of these stocks. So can you share with us a little bit about what put you into the bunker? What was it that, how quickly were you finding yourself just getting knocked out of your stocks? And did you wait until the 40 week moving average lines for a lot of those stocks? Because you had some big winners that you were holding on to.
Well, thank you. Yeah, when I used to go to the level 4s, I would look at the charts and, they'd show, buying here at the first stage base and then selling at the top and, 500% gain, 600% gain, and I'm like, how are they doing that?
You're like, I want that.
That's what I want.
Sign me up.
And all of them were cut off. Most of the charts were cut off when it broke the 40 week line. So when we were doing the research for the book, I was like, we got to test a 40 week rule. And so that's what we did. And we found that, the 40 week rule has the most potential for gains, but of course has the biggest drawdowns because you're waiting out all those bases. But because we also developed the mental capital preservation rule, where as long as the way I use it is I, set a number that I want to retain at least 50% of my gains. And once you have 100% gain or more, it works really well, in my opinion, where if it breaks the 40-week and it breaks the MCP 50, then usually it's done for a while. I can take my gains and go do something else for a while or whatever. And then if you really want to go long-term, you could do MCP 35. That one we didn't officially test out, but I've been playing with that one as well. And that's like really a long-term hold. Like I'm hoping for like, you know, a Microsoft or an Apple someday where I'm, you know, it's just a steady mover, the chugger, if you will, you know, with the big gains somewhere down the road. But really the 40-week line with a 50% retention of gains minimum has worked well for me.
And, you know, it's just I'm going to share with you real quick because I did a lot of those charts for the level 4s, of course. And I, you know, when I was choosing an end date, I think it was arbitrary that, you know, I wanted to show enough of a downside move that you knew it was done. And so I think I did choose the 40-week moving average line a lot of times, but I don't think I did that consciously. I think I just, you know, oh, this shows enough of the move down so that you get the sense that the move was over. So anyway, well, it's interesting you turned to study out of that.
Yeah, well, and the interesting thing too is, you know, we learned from Bill about, well, the first touch of the 10-week line is okay, and then the second one's probably okay, but then after that it might be done. Well, I've observed, I haven't officially tested it out or researched it, but with the strong, you know, true market leader, it'll do the same thing. It'll like touch the 40-week line once, then maybe twice, and then the third time is when it can be done. So if you're willing, like me, to hold through that drawdown, then it can be very rewarding.
Yeah, that's the hardest thing is that drawdown. I think for most people to give back even 50% of those gains is very, very difficult. But the great stocks aren't going to touch that 40-week line too often, and they're going to break it until they're really in trouble. I mean, we have the NASDAQ up right now, and I mean, you can see it on the NASDAQ here if you're watching on the video on investors.com/podcast. I mean, it really only broke the 40-week line in the middle of January this year, and it's kept you out of a lot of trouble, but it enabled you to catch a lot of those gains from 2020 when the market was getting back all the way through most of 2021. So it is, as long as it fits your personality, it is you're capturing the primary trend there.
Well, and just to add on to that, interestingly enough, we got almost right up to that 40-week moving average line, and that's exactly where we got turned away, you know, recently. So back in March, hit it, knocked the head back down, and then we did that again. Now it remains to be seen how serious this pullback is, but that 200-day moving average line, 40-week moving average line, is still, you know, an area of resistance for all the indexes. The Dow Jones Industrial Average and Russell 2000 did pop their heads above the 200-day moving average line, but only spent a few days above it before they reversed back below. And the S&P 500, I think, came within a few points of the 200-day line. So, yeah, it's an area of resistance right now.
Yeah, and so Kathy, I think you brought up another really good point about, you know, when the market is not your environment, you're taking a break, you're doing other things. Talk a little bit about the importance of taking that mental break away from the market, you know, to prepare yourself for the next time when the wind is behind your sails.
Yeah, well, one thing I did during that time, this year is I had to and it was during that period where we had, you know, I guess a couple follow through days. One of them didn't work. This one kind of worked. And, you know, I was trying.
I think we've had like what, 5?
We've had like 4 failed fall through.
I don't even know.
You've been away for a while.
Right. Well, you know, I was trying a few of them, and then, you know, I was losing, and I had to remind myself, I was saying earlier, what my setups were. So I actually created just a small like PowerPoint for myself where, you know, all the big leaders from the last year and even way back when, like, you know, Lululemon, I mean, really going back in time from 2009, 2011, because that was really my first great year where I was like, okay, I'm actually making progress and this is working for me, kind of thing. And I had to remind myself what it looked like, you know, where are these first stage bases and where are they forming? And literally that is what transitioned me to the more relaxed state where I was like, okay, I'm not buying just because it's a follow through day if I don't see the setups that I want. And I just called, I think I called it, what does it look like? Was the name of the file that I created. And it's just a bunch of charts with those first stage bases reminding me what it looks like, and all different kinds. There's some that are very volatile and then they tighten up and then they break, and some are tight, then get volatile and then they break. So really it can be any combination, but at least that, right? And then you know what you're looking for.
Yeah, so I pulled up the Lulu chart back in 2009, 2010 time period, and it looks like as the market got going in 2009, Lulu only really set up in July of 2009. And that's where it kind of gave that first base there. Was that where you were starting to identify a Lululemon?
Well, back then I didn't know what I know now. So unfortunately, I never owned Lululemon there, but because it was a big winner and it was one of those IPOs that had a run up and then went down and then created that first base right around that 40-week line, I knew it was a model that I wanted to continue to follow and study from. So yes, that's where I would have if I knew.
Yeah, that's how
you knew then what you know now.
Yeah, exactly.
It serves as a great reference.
Yes.
And yeah, I mean, so I think that is a really good point, because that is the first place where pattern recognition picked up an actual pattern, which is kind of what you're looking for when the market's truly kind of coming out of a bear market.
Right. And kudos to Market Smith and the pattern rec, because I know Scott O'Neill used to always say find the bases first and then double check with pattern rec. But what I like is, when I'm seeing it being built and then on that Friday pattern rec picks it up. Well, I already said this, but it's just such a great feature and confirming mechanism.
Right. Absolutely. Well, when we come back, we're going to talk a little bit more about what it is that Kathy is looking for in order to find these first stage bases early in their moves and the big winners. Stay tuned. We'll be right back. Hey traders, is inflation hurting you? Have you adjusted your strategies to account for it? Vantage Point can help you beat inflation with patented artificial intelligence. Go to www.freestockcoaching.com and discover how to predict stock market trends 1 to 3 days in advance with up to 87.4% proven accuracy. No matter which way the market moves, Vantage Point's AI can give you a massive edge and help you get ahead of inflation. Go to www.freestockcoaching.com and find your best entries and exits. That's www.freestockcoaching.com. Welcome back to the Investing with IBD podcast, sponsored by Vantage Point. It's Justin Nielsen here, along with my weekly guest, Arusha Pierce from O'Neill Global Advisors. And our special guest this week is Kathy Donnelly, co-author of the Lifecyle Trade and meetup leader, and just awesome woman in terms of Ironman triathlons that she's doing and all sorts of fun stuff. Kathy, we were talking a little bit about how you're really trying to get those home run pitches, those home runs from the fat pitches. And let's talk a little bit about how you get in early enough on these stocks that you can hold on to it for the big gain. What is it you're looking for?
Yeah, absolutely. I'd love to share how that kind of came to be, actually, because when I first started the system, and like many, I think, Bill said you have to buy the first stage base, and then, there's the second, and then the third or fourth may not be as successful. And I definitely, when I was buying back then, there was the fear factor, because is this really going to work? I'm putting my real money on the line. And I would buy extended from first stage bases, or because I was like, well, is it really working? I don't know. And then I would buy it, and then it'd be, it'd be overextended, and then it would pull back to the buy point like most of them do. And then I would end up, losing money all the way to the top because I keep buying and selling. And and so,
you see this big gainer that you lost money on.
Yeah, exactly. I didn't trust it. I didn't have the experience. And, it takes a long time. I know some people have likened learning, the system or investing just in general to a 4-year degree. And I definitely think that's probably what it took me. And actually, if I add up the time, I would say 2009 was the year I first really became successful. And then about 4 years later, around about where Bill O'Neill retired, and there was no longer any at level 4. And I was like, oh man, well, no level 4 with Bill O'Neill anyway. And Eve, shout out to my co-author Eve, we went on our own little stock investing retreat. And you know, we were just going to come up with things to study. And we carried all these books, all the big books from all the level 4s and level in our suitcase.
Where'd you carry it up to, like a top of a mountain or something?
No, we put them in a, you know, we put them in a suitcase and put them on the plane, and we brought them with us to California. We went to California for like a little beach stock retreat kind of thing, and we didn't really have an agenda except we did bring Brent Steenbarger's book, one of his psychology books that focused on, you know, focus on what you're good at and that kind of thing. So I remember one day we're sitting in the hotel room, and this is a great story, actually. It's not investing related, but just really quick. They messed up my hotel reservation. So we ended up with like a super duper 2-bedroom suite right on the beach because they messed up my reservation, something that I did not pay for, but got to enjoy thoroughly. And we're sitting there and I'm just looking at charts, you know, just, I don't know what I'm looking for. I'm just looking at them. And then finally it hit me. I got to buy these first stage bases, like, you know, 4 or 5 years later after I've been doing the system. And then, I don't know, that's just when it came to me. And then I really, really started honing in on that. And then I guess in combination with when we decided to do the research for the IPO study, you know, again, it's so important to get that first stage base. And for IPOs, when that due diligence phase, that institutional advance phase that I was talking about, and it, you know, exactly what Bill's been talking about all these years that I have been going to his seminars. So how do I find it? I mean,
well, before we get into how I find it, so you had to change kind of the way you looked at the markets, or you almost had to change your habits and just the actions that you were taking. So did you write new rules to kind of overcome that fear of buying a first stage base? Because it wasn't obvious at that point, you didn't see it start working. And of course, you know, you were losing money doing the other strategy, just kind of getting whipped around. Yeah, how did you change that? Because that's not easy to kind of change your habits once they're kind of ingrained in you.
Yeah, no, that's a great point, right? Because I was always buying the second and the third stage bases because, oh yeah, this one is a leader, but you know, I should have known it was a leader at the first stage.
Now it's obvious.
Yeah, exactly. I was buying when it was obvious. And I guess, you know, just looking at the charts there was nothing in my brain except I'm just looking at these, trying to see what I'm supposed to be seeing. And so in a way I was unfocused and my brain was clear. And it finally just like clicked. You know how like Bill told me all the rules I ever wanted to know at the first level 3 I went to in Chicago in like 2006 or 7 or whenever it was. And I go back and listen to that and I'm like, oh, if I had applied every single thing he said at the level 3, I would have been there a lot faster. But it just doesn't click, right? Because there's just so much.
You have to kind of do it yourself a little bit.
Exactly. So it just, Arusha, I mean, yeah, I'm sure I wrote it down. I have most of my rules written down in some form or fashion, but it just like the light bulb went off and it's like, oh, duh, you know, and if it doesn't work, you just sell it.
Right.
But it seems like, I don't want to say they're sure things because nothing's a sure thing, but maybe it's not a sure
odds. It puts the odds in your favor.
It puts the odds in your favor. And it might just be a 20%. But it definitely could be more, and it's totally worth it when you find those first stage bases. So it's worth looking for and being patient and not chasing, you know.
Well, and as you mentioned, it only takes a few of those that you're right on and that you really handle well to have kind of that big change in your portfolio. So let's get back to it. What is it? What is it that you came up with? What were the epiphanies? Do we all have to get 2-bedroom suites on the beach in order to become better investors? Because if that's what you're saying, I think I'm okay with this. Arusha, do you want to have a retreat?
I've already reserved one, Justin. So
okay, perfect. So tell us what you came up with and what kind of rules you started using after that retreat.
Well, it can be, you know, you definitely need some type of bottom in place, right? And let's look at one that makes it easier. So like Twilio,
Sure.
Twilio was the big winner for me. And this is a recent IPO. Well, not as recent now. But
so you're talking about Twilio back like in 2018.
Exactly.
There, that first kind of base. So in 2016, it went on this big run, came out of an IPO base, corrected, and went through the due diligence phase, and then started setting up. MarketSmith started picking up the pattern there, and so that was where you really started going for it.
Right. So the first thing that I'm looking for on a recent IPO is the 40-week line. When the 40-week line first starts to appear on the chart, that's when I'm like really taking notice, because now I know there's a minimum amount of time. What I accept as a minimum amount of time that this IPO has been out, where the potential now has changed, where it could start building that first mature base, and then hopefully have a good run after that. Now in this case, it took quite a while. That's a pretty long due diligence phase. And you can see it when it first came up around that 40-week line, a little bit more to the left. Yeah, right there where it's real tight around there. I thought that was going to be the first mature base.
Okay.
And I did try it in there, but it didn't work. It failed, went back below. And then that gap up bar was on, I believe, earnings, if I recall.
Right.
And that's when I was buying it, trying it again. Right now it's back above that 40-week line. And what I found is, especially on these bottoms, it's usually an earnings catalyst. Like there's going to be a gap up, then a base, or there's going to be a base and then a gap up. And that's usually the start of it. And in this case, it was the gap up within that base, and then soon thereafter continued on.
So let's go back to the first time where you tried it, where it came above the 40-week line. So maybe like in July of 2017, that's where you were entering it. When did you cut your losses? Was it?
I was actually. Let me interrupt you, just because
Sure,
I was actually probably entering it. I'm trying to point at the screen. No one knows what I'm pointing at. To the right, a little more to the right, where it was tight, and then it popped up from that tight action.
Okay.
Nice 3 weeks tight.
Yeah.
Exactly. Because in the first point, it was still just
that's
having
October
a prior run up.
2017.
Yeah, it was a prior run up into that 40-week line, and then it was tight around that 40-week line. And then when it popped up from that, that's where I was trying some initial small positions.
Okay.
And then that failed soon thereafter.
Okay. And so then in November 2017, that's where you're cutting your losses. Now, do you wait till the end? Did you wait till the end of the week to see if it could recover back above the 40-week line, or it was like during the middle of the week you had a percentage just kind of stop to force you out?
Yeah, my longer term sell rules are more of a wait till Friday. Shorter term, if it looks like a clear reversal, I'm out.
Okay.
Yeah.
It's very different when you have a big cushion on something. You can give it that room, that patience, but when you're just starting, you don't want to necessarily, let's just wait for a little bit longer and see what happens, because they can kind of come down real quick.
Right, exactly.
So yeah, fast forward, and it really kind of hovered at a level just around 26 for a number of weeks. So a lot of congestion right around there, and then that pop that you mentioned. And so first of all, I think you have to be commended, because one of the things that happens with some people is once they try something and it doesn't work, they're like, forget it, I'm never trying you again. You burned me once, type thing. But you said, okay, there's an earnings report out, it's being revalued, and people are looking at this differently, and you said, I'm going to give this another shot.
Exactly. And with Twilio too, this is a great stock to talk about, because in its IPO advanced phase, it also went up 100% within 90 days. So we usually in the book, we put those in a different category that we call a rare jewel, because those have the potential to gain 500% or more in their lifetime, which in this case, Twilio did do. So it was also on like a special list to keep watching it.
But that's kind of after the fact you put it into that separate group. So is there anything else like in the early phase? I mean, this was something that had been down quite a bit. I mean, if you hover over the base, it says that the base is 33%, but I mean, it had already suffered a lot of destruction from 80 down to the top of that base, so it was already down 50%. So is there anything in terms of hey, this is too much, or it has to make a certain amount of recovery before you're getting interested in it. You know, that whole difference between buying something kind of at the bottom versus, hey, this has proven itself. What was it about Twilio that kind of put it into this isn't bottom fishing, this is something that's, you know, shown something different?
Well, because it had several years of sideways action, I don't consider it a bottom anymore. Maybe we could call it a bottoming base. I don't know if that's how you officially define it. If it was just a bottom, like if you go to the far left when it kind of started to go sideways, like that would be like a bottom I would not buy. I would want some sideways action unless it somehow formed a really good base there, but that's not likely. I don't usually see that happen. But I do observe, Justin, I mean, you said 30 odd percent, a lot of them are pretty deep sometimes in that first base, especially when you're coming out of, bear market. And Bill has said that we have that in our rules that bear market bases can be much deeper than the actual market. Right. But that doesn't bother me because of knowing that reason and what it's come out of. And sometimes they can be really ugly. I think FVRR was another good example of that. You don't have to pull it up, but I mean, it had some tight and then it had a really ugly, like shakeout base, and then it moved on. So that's, to me, that's common and it's expected and it doesn't bother me.
Okay. So now you're in the position. Are you adding to the position, or you get kind of your initial position? Now you're really letting it ride until the second stage base. How do you approach it after kind of getting that good entry?
Yeah, so I get the initial position in, hopefully at that first stage base. And then I'm looking for secondary opportunities to get to a second full position. And so since in this case, we're not even at the turbulence zone yet. So if I can start adding at, maybe the bounce of the 10-week like this one did, or other little type consolidations, I'm adding along the way. But essentially, I want to have my second full position in either before or finished at that second stage base, which can occur at that turbulence zone area or right below or right above, which is the prior high of the initial run from the IPO. And then at that point, then I'm done. I don't add after that because then I just want to be able, because we already know the third stage base and the fourth stage base, things are going to get more volatile. And at that point, hopefully I've had 100% gain. And now I'm just about riding that 40-week line and ensuring a 50% gain retention.
Okay.
And
go ahead.
Go ahead. No, you finish first.
well, because now you put Twilio or Twilio qualified for that other tier, right, where it has even more potential. So how does that adjust the rules in this case here after the second stage base? Are you using the 40-week line and exiting when it's back in 2019, or are you trying to ride through that base because you have such a big cushion on it?
Yeah, no, when it broke there where you have that last little red hash mark, I believe that's where the 50% and the 40-week line, they both kind of came together at the same point. And I don't know if it's a coincidence, I haven't done the math, but it always seems to happen around the same time frame. So I was out of it at that point. I don't adjust my position just because it's a rare jewel. It's all positions are the same, no matter the stock that I'm going to commit my money to. And that's another, I'm just always want to make sure I give credit to William O'Neill. And I think I learned that at the level 3, where it's like, any stock that you're going to put money in should have the same position or you shouldn't be buying it.
That's a good point.
And just, because you've referred to it a couple of times, you referred to the MCP, just remind people of what that rule is for you.
Yeah, so Eric Kroll, my other co-author, he actually developed that idea where, we need to preserve our mental capital. And it was actually, I think, Jesse Livermore that really talked about it a lot in his book. And so he was able to actually put some numbers to it where, if you have so much of a gain and you come back this much percent, how much gain are you, how much are you retaining of your gains? And so he did all the way from, 10 to like, 100, right? Which 100% of your gains you'd have to hit the top tick, right? So that would be very challenging. But he said 50% should be a good baseline. And if we can do that, then mentally we can survive. And I don't know if that's the best way to say it, but that's kind of how I think about it. It's like, oh, well, I don't need to worry about this because, but again, you have, for me, and I think it really works best, you have to have at least 100% gain or more. You really can't apply it on just a 20% gain. That's not going to work. I mean, I can show you the math, right? But when you have 100%, if you're willing to hold through a 20 to 30% base, then that's well within, you know, and I don't have the chart in front of me, so I can't tell you exactly, but holding for 50% of your gains is really mentally not an issue from that perspective. And then when I've added the 40-week line to it as well, because I'm pretty confident I've got a true market leader in most cases, it doesn't faze me. So it's just a way to, I guess, put your brain at like relaxation mode during corrections. If that makes any sense.
Yeah. No, absolutely. So let's step back a minute, just to that original base. Now you gave it a try and that one didn't work, but then you tried it again. And one thing that kind of sticks out to me here is that the relative strength line was pretty poor. It looks like, you know, I mean, during 2017, look, this was a great year for the market, a very, you know, straight up kind of almost, where there was very little volatility. The S&P 500 didn't correct more than 3%. So is that relative strength line an issue in this case, or how did you kind of overcome that? There was a little weakness there because it was basing during such a strong market.
Yeah, I'm absolutely keeping my eye on the relative strength line. I mean, the relative strength line is key in a lot of cases. You know, obviously after that big gap up bar, the relative strength line did shoot up. So it is back at the prior highs that it was during the other consolidating that it was doing earlier. So, you know, and that happens a lot, right? The relative strength line doesn't look real good, then it has a gap up in earnings and then it pops up. I mean, obviously I agree it's ideal if it's already up. But you know, on IPOs and things like this nature, you have to take all that into consideration in what you're looking at.
Very good. Well, when we come back, we're going to talk more with Kathy about some of the stocks that are on her radar right now that might be in these early stage bases. Stay tuned. We'll be right back. Hey traders, is inflation hurting you? Have you adjusted your strategies to account for it? Vantage Point can help you beat inflation with patented artificial intelligence. Go to www.freestockcoaching.com and discover how to predict stock market trends 1 to 3 days in advance with up to 87.4% proven accuracy. No matter which way the market moves, Vantage Point's AI can give you a massive edge and help you get ahead of inflation. Go to www.freestockcoaching.com and find your best entries and exits. That's www.freestockcoaching.com. Okay, welcome back to the Investing with IBD podcast sponsored by Vantage Point. It's Justin Nielsen here, along with Arusha Pires from O'Neill Global Advisors and the co-author of Lifecyle Trade. It's Kathy Donnelly returning to the show. And Kathy, we've kind of got an idea of what you've looked for in the past. Maybe you could kind of give us a sense of some of the stocks that are on your radar right now. What do you want to start with?
Yeah, absolutely. I'd like to start with Ollie. You know, this has been one.
Ticker symbol OLLI.
Yes, OLLI.
And as a reminder for our folks that are listening, you can also watch the video at investors.com/podcast as we go through some of these charts. But yeah, go ahead, Kathy.
Yeah, so when we were talking earlier, you know, I was talking about the screens that I run, and generally my first priority is to run the screens for recent IPOs, but I also would run screens on other mature stocks as well. And Ollie was one that had popped up on my radar, and you know, it was a David Ryan favorite for many years. And I remember when I saw him speak a few years ago at the level 4. You know, he was talking about the stock. And one thing I remember he said is, keep this on your radar. You know, they had a couple of bad quarters, but I think they're a really good company. So, you know, when I see it pop up, I'm like, oh yeah, David Ryan talked about this. So, you know, got to keep it on my radar. And what's really great about it is that, you know, it's not a recent IPO. It's like, you know, within the last 2 years, but it's building a similar pattern that I like to look for in recent IPOs. And I want to just show this as an example because it can be applied to more mature stocks as well. Because, stocks run up, they consolidate for a long period of time. You could consider it another due diligence phase of some sort, right? Because it's had a great run. Now it hasn't, can't beat its numbers anymore. It has to retool. They've changed things, but they can reinvent themselves. We've seen that many times with many stocks. And, although Ollie does not have great fundamentals and sales, it built a really nice cup with handle base below the 40-week line there. So kind of had a decline. It, didn't really go that well sideways, but kind of popped up and built that nice little cup with handle. And I know Ken Shreve talked about it on a recent IBD podcast. And I was like, yeah, I saw it too, but I didn't buy it. And Ken bought it. So, but when I looked at this, I was like, this is for sure something I could buy and get like a 20% on. And, it actually kind of broke out during earnings from that. I believe it's a cup with handle. But, kind of went halfway. And I did see it happen and I never pulled the trigger, but it was a successful stock if you had sold it at 20%. And then now it's already built another little cup with handle. And at this point, I haven't decided if I'm going to take action on it, but it is on my potential action list. I do have a list of action lists where, if it breaks out, it's actionable. So anyway, I just wanted to share this one because I think it's just a great example of how you can continue to look for those first stage bases, mature stocks, recent IPOs, and they'll form right below that 200-day, 40-week line on the weekly chart or right above. And in this case, we've got a second stage base already happening here. So maybe something is changing with Ollie, like David Ryan was saying. And so we'll see what happens.
So so it looks like they're going to report earnings next week. Does that affect, or how do you modify your strategy when an earnings is coming up within a week or so?
Yeah, well, I'm glad you mentioned that because I did not know it was reporting next week. So in that case, I'll absolutely wait. I won't buy it ahead of time. Not if it's within a week. If it's within a couple weeks, I'll definitely probably try it. But the same week or the next week, to me, that's a little risky. So that'll be interesting if it does the same thing. Sorry, Justin.
No, I was just going to say, you mentioned that a lot of times those earnings reports can be the catalyst for your gap up. So that might be, kind of fitting right into your evil plans here because, it's got the setup and, all you need is that catalyst. And if earnings provide the catalyst for you for that breakout, you could be in business there.
Right. It is definitely part of my successful plan. And that was the
not the evil plan, the successful.
Yeah, maybe the successful evil plan.
From the first stage base, that was a breakout on earnings. So yeah, absolutely.
But now let's take that step back to what we were saying about the market at the beginning. If you're seeing a setup like this, but you're not quite convinced about the market, do you kind of make the individual stocks they take precedence here, or how do you kind of maneuver between those two conflicting components?
That's a great question, and I would always lean toward the stock action before the market action. So if it is, because I know the odds are not in my favor, but I don't like when the market is down that this happened a few years ago where I turned off oh man, the market's down. Oh, my stocks are down. I need to sell. Like I turned that off. The market's down, but yeah, my stock's down, but it's on low volume or it looks fine on the weekly chart. Who cares? I always go back to the weekly chart because that's the big picture. And if it looks fine on the weekly chart, I don't even think about it. But because we are now correcting, and, I was saying before, I was trying some 1%, and then I was hoping to put full positions on. Well, this probably is a situation where I might just still keep playing around with 1% positions, to be honest, because I do not like how everything is starting to roll over.
And so with those 1% positions, are you using that as feedback to get a little bit more insight when to get more aggressive, or is it just more of the setups? There are more and more setups coming and things are acting better. It might not necessarily be the feedback on the original kind of 1% positions that you put in.
Yeah, I mean, obviously, it's a way to stay connected in the market. I mean, that's one way I like to do it, and it's low stress because it's a 1% position.
Right,
So if
right.
it doesn't work, it doesn't. I don't worry about it. You know, I'm not getting 1,000 knife cuts. You know, maybe just a few, and they're
Right.
very small. You know, they're maybe it's just splinters. You know what I mean?
Yeah.
So yeah, and I've been enjoying that. Like, okay, I still kind of in the market, but I'm not. It's again just not building a high stress situation until I see more opportunities.
Mm-hmm. So speaking of other opportunities, what else do you have for us, Kathy?
What else do I have for you? I want to talk about TOST.
Wow, look at that.
TOST. And the reason why I want to talk about it is because I think the what they're doing is really interesting. And I don't know if you guys have noticed it on your receipts when you go to restaurants in California. But it's pretty amazing. I mean, it really clicked for me when I went to a restaurant and like literally everything was on the phone. You know, you scan it, you order, you tell them what table you're at, and they just bring you your food. And you don't even, you don't barely have a waiter or waitress asking you all these things. And I just thought that was amazing because when, everything started opening up, there wasn't enough people and people are still shorthanded. And this was a way to, allow them to still, be open and have food, but not need as many people to help, with the service. So anyway,
well, Kathy, when you say scan it, are you talking about like you scan like a barcode and like the menu comes up on your phone and then you select your item and then they bring it out? Is that what you're talking about? Scan? Okay.
Yeah, you scan it, and then the table has a number. You say what you want, and then they'll say, "Oh, you're sitting next to whoever," and they're ordering what they want. And it's literally like an open ticket, like an open bar. And it can be an open bar, but also open food. And you just keep ordering until you're done, and then just keep bringing it. And no one comes and asks you what you want. You're literally just doing it all on your phone.
That's interesting. I haven't tried that. I've used Toast to process orders. So you just go on the app and Toast is processing it and does all the payment stuff. But I haven't used that part. That's a really interesting experience right there.
Yeah, it was really interesting. It was, and I've used it more than once. And one time we sat down. We're like, how come nobody's coming? Because we actually didn't realize they had that. They're like, oh, you just do this, and I'll just bring it to you. And
wow.
Yeah, and it's very convenient. And I went and researched on their website a little bit too, and it's just amazing the different options they have to get restaurants going. So this one from a new and what they're doing that I've experienced, I think has some interesting potential. And so that's why I wanted to bring it up. So obviously you can see it's had a huge downtrend here, and I'm not buying that bottom and base. It's not very long. It's very volatile, but now it's got a prior run up. And remember how I mentioned the 40-week line?
Yep.
I really like to pay attention.
Yep.
So it's just starting. It just started to form. It hasn't even touched it yet. So this is, I don't want to say ripe, but I do want to say ripe. This is ripe for
you say ripe if you want to, Kathy.
For a potential first stage base. Now it's got at least 7 weeks, probably, right? If a cup with handle 7 weeks, maybe it's got 1 week in. I don't know what's going to happen, but this is what I like to see, and this is where I'm like, okay, every week I'm watching it, and maybe 7 weeks from now, 6 weeks from now, there's going to be something there. I mean, it might not work at all, but I know what they do. I understand it. I'm going to wait for that first mature base. And then hopefully I see it, I'm watching it. And then that Friday comes, Market Smith finds it on pattern rect as well. And, we'll see what happens. So anyway, I think it's still pretty thin, and, but it does have some sales. So, we'll see.
It actually has some pretty strong sales. I mean, this is, 675 million in the last quarter. So, and you've got a number of quarters there with triple-digit sales growth. And I mean, the last quarter was 58%, and that's nothing to sneeze at, especially with such a large number. But now there aren't any earnings. A few years ago, it seemed like, well, gosh, all you need is the big sales growth. Earnings don't matter. And then as this year kind of unfolded, that became all of a sudden earnings were a lot more important and PEs became important. So is that earnings component, is that something that bothers you at all right now?
I mean, I would love to have earnings, of course, but sales is number one, especially on a recent IPO. Have some sales, earnings, maybe they come in later. You know, check the sponsorship, maybe check your owners and funds tab. I'm just curious because you
T.
mind
Rowe
changing
Price
it
New
quick,
Horizons is in
Krishna?
there.
Yeah, there you go. So we got, it looks like they reduced, but
Not
it
by
does,
very much.
Yeah,
but there is some, it does look like there's some accumulation happening. You know, it looks like it also recently reported earnings. So we'll see. You know, there's time, but for recent IPO, for me, definitely want to see sales. Earnings would be nice, but I'll still buy it if it doesn't have earnings.
What about the angle of the 40-week line? Because it's just kind of straight down now. Does that tell you anything that this might need maybe more than 7 weeks? Maybe it needs 3 months to start going sideways. Kind of, I think like even Twilio it was going much more flat by the time you started entering into it.
Well, I think what could happen, you know, what would be ideal is if it continues to go sideways, it's going to straddle it. And
Okay.
that's totally fine.
Okay.
Totally fine with that.
Very
You
good.
know, straddle the price bars, the weekly price bars.
Right.
Yeah.
Okay, so that's two down. One more for you. What else you got?
Well, I think we have to talk about Duolingo.
Okay, so ticker symbol DUO on that one, right?
DUOL.
Excuse me.
Yep.
Yeah. So I've talked about this one before. I talked about it with Alyssa on Stocktails, and I think I've talked about it before because I'm a user. I'm a 911-day streak.
Wow.
What
A streak of doing what?
Yeah, and I've actually been using it more than that. But I've been on a mission to learn Spanish for years. And, you know, I kicked myself because I took 3 years in high school and didn't practice. So
Did any of it come back once you did
oh yeah,
doing Duolingo? Okay.
yeah, definitely some of it came back, but you know, it's all about vocabulary and practice. But I think it's an amazing tool. It's just on your phone. You can, you know, it's more than just Spanish. And so, and it works. So my mom speaks Spanish, but again, we didn't learn as kids either. But now my mom and I can have some conversations in Spanish, and I can talk to her in Spanish, and that's all just from my phone. She'll say to me, "Oh, you must be practicing with somebody," and I'm like, "No, I'm just doing it on my phone."
So
So
how
anyway,
do you practice on? Well, how do you practice on your phone? So it says it, and then you repeat it, and it's listening to you and plays it back, or something, or how does that work?
yeah, so you have a lesson, and the lesson is, you know, it talks to you. You have to repeat it back. Sometimes you have to write it out. Sometimes they give you the words, and you have to put them in the right order. There's also stories you can listen to, and then you have to answer the questions. So there's lots of different options, but it incorporates everything: speaking and writing and listening and selecting the right answers and all of that. So it's a great combination.
So we have the 40-week line that has appeared here. We've got the a base. Now this is actually a pretty, you know, a pretty shallow base, 22%. I mean, that's not bad. Here's another one, DUOL is the ticker symbol, that has some pretty good sales, but doesn't have earnings. So is this kind of in a similar boat in terms of that sales? The sales aren't as large on absolute numbers as they were for TOST, but still 88.4 million for the last quarter. That's not a small number. Anything else on the fundamental side to add?
You know, this is me being a believer of the product.
Okay.
And when I've looked at their earnings reports, you know, they see their market for online learning increasing dramatically. You know, someone asked me, "Oh, well, don't you think Google Translate and all that, people aren't going to want to learn a language?" And based on their research, that's not the case. People, I think, like learning languages. And I have friends that use it as well, and we follow each other. So yeah, I don't know. I mean, you've got 3 good institutional O'Neill funds in it. I mean, it's definitely been volatile. You know, talk about the technical action. They've had some really huge blue shakeout bars there, and even this base is kind of, you know, I would say sloppy, even at 22%. I mean, it moves a lot. This base just got picked up on MarketSmith on Friday because I watch it every week. And it is straddling that line. So it's going to be interesting to see if it can power through. It's definitely having trouble at that 100 mark, which, you know, is happens a lot with stocks around $100. But I'm a believer of the product. So, I'm probably a little bit biased. I do have some. I've chipped away a little bit here and there. I'm probably a little negative on it though, but I'm still holding on to it again. 1% position. So
not going to hurt you that much.
Yeah.
One other thing that sticks out to me on this is that the R&D is 41.4%. That's pretty high. I mean, this isn't like a biotech stock, right? But they're putting a lot of that revenue back into the research and development side.
Yeah, I've definitely seen them change. I've been using them for quite a few years now. They have family plans now, and they offer all these different things, and they give you free trials for the full product. And so they're definitely trying different things. If you do not want to be a paid subscriber, you can totally use it for free, and you just have to watch the ads. You pay for it by watching the ads. So if you're okay with that, you can use it for free. So
great. Well, anything else on this one? Any other questions from you, Arusha? Or are we going to go learn Spanish together?
Yeah, I mean, she's definitely made me more interested in Duolingo, that's for sure. So
yeah, well done, Kathy. Maybe you made some believers here. Kathy, gotta thank you once again for joining our show. It's always a pleasure to have you. Thanks so much for being here.
Oh, it was a pleasure. I have so much fun, and I love you guys. So thanks. Keep up the good work, and just very appreciative for everything that you've done for all the individuals, investors that William O'Neill laid out for us.
And you know what? I just want to kind of reiterate one more thing, because you did say about how you put a lot of stuff in PowerPoints, and I think that's something that a lot of people could benefit from. That you kind of have trained your eye to look at charts by looking at, hey, these are the ones that you need to look at. These are the ones you need to learn from. Whatever you can do to kind of train your brain to recognize those. So I think the PowerPoint idea that you have, and I know you've shared that with your meetup members, because I've been to a number of your meetups before. So that's a great thing. So you're definitely spreading the knowledge as well, Kathy. So thanks for that.
Thank you.
Okay. And on the show next week, we are going to have Andrew Channon back on the show. Last time he was on, we were talking about UFOs, space, and defense. So we'll see what is on his brain right now when he comes back to the show next week. Thank you so much for being here with us this week. We'll see you next time. Make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.